All right, so today we're going to dive into a little bit deeper dive on cryptocurrency in general, but also answering the question, has Bitcoin entered a bear market? And joining me today is Lyn Alden, who is basically a researcher and analyst around the financials market. Great to have you on the show here, Lyn.
Happy to be here. Thanks for having me.
Lyn, let's just jump into a little bit about you and your background. How long have you been doing analysis, kind of the setup that's put you into the business you're in?
So I've been investing for over 15 years, but my primary background was in engineering and engineering management, and so I gradually kind of shifted more and more towards doing financial research until that became my primary business, and I eventually left the engineering field, and so I cover tech investments, many other industries as well. Cover precious metals, and then starting in 2017, I initiated coverage of digital assets because that was clearly a growing field. And so back then I was more cautious, but I became quite bullish in early 2020 on the space.
Yeah. Digital assets are obviously exploding. We've seen kind of I would say in this particular bull run or this particular cycle when it comes to cryptocurrency, it seems to have come to at least mainstream, to where we have not only mainstream media talking about it, but also mainstream financial markets that have really kind of perked up and started to address it. When you look at the current, global monetary system and what's happening with both the US dollar and also the digital yuan coming out of China. What is your forecast on how this is going to shake out maybe in, say, the next decade? Do you feel like cryptocurrencies and digital assets in general will continue on their track to be kind of a unique asset class, or do you think there's going to be at some point some sort of conversion?
I think we could start to see more integration because, for example, we see NYDIG, for example, is rolling out the ability for banks to be able to offer their customers to buy Bitcoin directly within their
Right.
mobile app or within their accounts. And so I do think, and same thing with PayPal, for example, PayPal, not a crypto business, but now is in the crypto business. And so I think over time you'll see more and more of those areas converge. But I mean, there are certainly some areas that could be disrupted, but a lot of people, for example, think the crypto industry is going to eat the banking system, whereas
Yeah.
I see things kind of likely, converging as we go deeper into the decade, the bigger that ecosystem gets.
Yeah, so more integration into the banking system, traditional finance or CFI as they call it. Um, so when you look at that being CFI and where some of the CBDC, and just central banks in general of potentially becoming and getting more interested in digital currency, you've got the European Union that of course is moving towards a digital euro. You've got China already in place with the yuan. The US has got some projects at least underway with MIT. There's a little bit of action in the space. Do you feel like there is a bit of an arms race happening right now for digital currency, at least at the sovereign side?
Absolutely. Well, I mean, I think there's a couple ways to look at it. There's, the sovereign side, and then there's also the big question of how much of it is going to be private versus sovereign. And so we see a
Right.
couple different factions. I mean, obviously there's the bearer assets like Bitcoin, right? So the ones that are kind of the most decentralized, they're their own asset. They're not tied to any other, physical, security or things like that. Then you have stable coins, which I think are good innovation, but they primarily been used for as a unit of account for trading, right? So
Right.
and of course, you've had some challenges in that space in terms of whether they're collateralized as they should be, things like that. So I think over time we're going to see more and more regulated stable coins, and we see, for example, projects like Facebook. Their Libra, then their DM. They've changed it over time, but they're looking to get into stable coins more as payments than as trading, right? So I think that technology can go further, and I think the big question that's going to run into then is the third type, which would be central bank digital currencies, and whether or not we're going to see central banks try to have a monopoly on that
Yeah.
area, or if they're going to employ some of these private entities to kind of extend their reach rather than them being like the monopoly. And so if you look at, for example, DM's white paper, they talk about integrating with CBDCs. I mean, they view themselves as kind of potentially expanding that market, and we're still very early in this process, so it remains to be seen how policymakers are going to want to go. And you could have very different environments. You could have China say go, they want to control the whole stack, and you could see the United States, for example, partner with some of these private stablecoin companies rather than wanting to control the whole system. And so we'll see how that
Right.
shakes out.
Yeah, I want to get into stablecoins a little deeper. Onto the Bitcoin topic. When you look at what Grayscale has done, if you look at last year, Grayscale, GB, basically the Bitcoin Trust, and some of the things and actions that were happening in 2020, a lot of movement in terms of accumulation. Do you feel like that Grayscale kind of initiated the bull run on Bitcoin last year in 2020?
I wouldn't say they initiated it, but I think they add a lot of fuel to the fire. And it wasn't their fault. It's just the construction of the fund itself,
Right,
because because it has a premium, there's that natural arbitrage. And so people can, lock up they can, take Bitcoins off the liquid markets, lock them into Grayscale, and they can then go on the side, they can short Bitcoin, and they can hold that trade for 6 months until the lockup period expires, and then they can end that position and capture that premium over NAV. But the thing is, every time they do that trade, their Bitcoins stay in that fund forever. There's no
right,
redemption
right,
process. And so that was like a gigantic honeypot that kind of pulled in Bitcoin. I mean, they were the biggest Bitcoin buyer in the second half of 2020. And I think
right.
that accelerated the bull market, brought it up to maybe higher and faster than it that otherwise would have gone. And of course, when we started to get other types of products in the market that maybe made that offering with their fees and things like that a little bit less competitive, we've seen that premium go away, and so that extra layer of neutral arbitrage demand went away. But I think underneath that rally, you still see organic growth and adoption, and that just kind of accelerated it. So now we've seen that kind of wiped off. That's no longer a factor, and so
Hmm.
as we go forward, it'd be back to that organic growth.
Yeah, kind of the demand of where it is now. So when you look at the market as it is, a lot of institutional movement. We've seen everything from ETF proposals that have been put into play from Kathy Woods and many others that are trying to move in this direction that all could have a little bit of a bearing on where we go in terms of the Bitcoin market and cryptocurrency in general, because there's a lot in the way of Ethereum trusts and quite a bit in the way, and of course, even Grayscale to a certain extent has a lot of those diversifications already in place. Your thoughts on whether or not we've actually hit the bear market on Bitcoin? Do you think we're there now, or do you feel like this may still have some life left in this particular cycle?
So the first stages, I don't know, but I would say that my base case leans towards the bull run that we saw in 2013, which was that it went up in two very distinct phases, right? So it went
Right.
up very quickly, then it had a really, sizable correction, long correction, then went up another run up. Whereas a lot of people looking at the 2017 bull run, which even though there were 30% corrections, there was none of that gigantic prolonged corrections. And so I think so far this is playing out like 2013. A lot of the on-chain indicators still look reasonably bullish. We still see ongoing adoption, which somewhat differs in those previous bear markets. And so that looks healthy. So overall, my case is that the bull market is probably still on, and that Grayscale just kind of accelerated it and then pulled that acceleration back. But that
Yeah.
still remains to be seen. We have to see what happens with macro environments because now these ecosystems are big enough that they can be impacted by macro events. It's kind of like how if a small tech stock is growing, they can pretty much
Hmm.
grow regardless of economic cycles. But once they get very big, they become more directly tied into the economic cycle. And I think we're seeing that to some extent with Bitcoin and maybe Ethereum and some the broader space as a whole.
Yeah, kind of the blue chippers. That's interesting. So I like that in the sense of and I would agree the on-chain indicators that we've looked at from data sets that we follow here on the network do point into still a bullish direction for Bitcoin. Your thoughts, though, I mean, and I have, we've got several analysts that we've spoke to over the past year, 6 months, that are looking at Bitcoin in general, cryptocurrency, where maybe the cycles may not be as clear and definitive as they've been in the past. In other words, meaning Bitcoin may end up having some soft periods, but maybe never really see that pure fallout that we typically see in these past cycles due to a few indicators around adoption, obviously mass market, institutional. There's so many new influences, in the space at this time. What are your thoughts on that? Do you feel like that is still going to be the case just because of the sheer supply mechanism being in play?
So I agree. And one thing is we never, if you look at most on-chain indicators, we never got as euphoric in this cycle as we got
Hmm.
in the previous cycles. And so if you're comparing it to that absolute top, is basically less of a, a kind of a retrace to get back up there. But then two, as this, the halving cycles get less important, right? Because it used to be years ago that, the new supply of Bitcoin was still pretty meaningful. And so when that
Right.
new supply got cut in half, that's a pretty big supply shock for, the existing supply demand balance at the time when that happens, and then going up the next, the year after that, the 18 months after that. But as they get smaller, that becomes an increasingly small percentage of supply in the market. And then in addition, I mean, now we have, if you look at the North American miners, a lot of their plans are just to hold whatever Bitcoin they mine.
Hmm.
And so overall, we don't really have a ton of new supply from mining on the market. And instead, it's really about going through weaker hands that maybe bought, didn't understand what they owned and then sold it, overall trading volume. And you're kind of comparing that to this underlying accumulation volume from people that either don't sell or rarely sell. So I
Right.
think as now that we have more institutions in the place and now we've gotten bigger, I do think that these cycles could shorten and soften potentially
Yeah.
as get more in tune with the macro environment.
Yeah, I'm almost in on that. The more I research it, the more I talk to more analysts and really financial study groups that are really looking at this in a big way, mainly because of the institutional side of things. My other factor here that I really think is going to change kind of the future of cryptocurrency is the retail adoption from mom and pop America and really around the world, especially as we see emerging markets really adopting cryptocurrency. So I would agree with you. I think will start to see that softer element there when it comes to it. Let's talk a little bit about research tools. We use a whole variety here on the network to kind of analyze individual token projects, flow of where the market is going in terms of market caps, et cetera. I want to talk about Plan B's model on stock to flow and whether or not that is a usable research tool for what we're seeing now, especially if we could run up and still see a little bit left on this bull run, maybe to a six-figure number for Bitcoin. Do you feel like Plan B's model works out there? Because I've done some analysis on what Plan B is kind of forecasting there, and it starts to break down as you start to accelerate the model up. What are your thoughts on that?
My overall view of the model is that I think it's going in the right direction. I think that focusing on the stock to flow ratio and specifically Bitcoin's increasing stock to flow ratio is a very useful way to look at it. And then also, it basically those halving events matter. And so
Right.
part of my shift from being kind of neutral on Bitcoin to bullish on Bitcoin was seeing charts like that kind of woke me up and said, okay, actually there's a clear pattern here. When you look at the logarithmic price chart, a lot of people fall into the trap of looking at the linear price chart, and it always
Hmm.
looks like a bubble. Whereas if you back up and look at the logarithmic price chart, that gives you kind of a more calm analysis of what events maybe led to some of these price run-ups. And so I do think that his conception of the stock to flow ratio, especially as it relates to the halving events, is really important. Now, my case for a while has been that I'm not relying on a specific price target from that model. I think that model is useful for indicating direction, and I think that the underlying kind of idea is sound. But whether or not that specific, prior algorithm that he calculated will continue to fit remains an open
Yeah.
question because a
Yeah.
lot of that was back tested, but then it continued to be pretty accurate, since he launched it. And I think the question is how long will that continue to be accurate? I think another way to look at it is the demand model. And so Jurian Timmer from Fidelity, he's their macro director at Fidelity. He often posts like a combined model that has like the stock to flow model on it, but then he also has this demand curve of adoption. Um, and so generally you see Bitcoin's price kind of bouncing around those two. And so the stock to flow ratio gives you more aggressive kind of price targets. The demand model gives you a little bit less aggressive price targets. And so I think having both of them on a chart with price tends to be helpful. Is how I look at it.
Yeah. How do you think, and I want to kind of get into some of the economic forces that could affect where Bitcoin and crypto, really all markets could go. In the fall, we could see a little bit more of a surge in terms of COVID. We could see maybe a market correction. Obviously, real estate, there's just so much that feels quite a bit overpriced right now. And I don't necessarily think that the market is completely priced in terms of adjusting to a lot of these kind of things. What are your thoughts on how market adjustments could affect cryptocurrency, specifically over the next year to 18 months?
So because it's still small enough and growthy enough that it's not in that large cap kind of value camp that's directly tied to the economic cycles, even
Right.
though it's big enough that it's starting to get influenced by them. So I certainly think in any multi-week or multi-month period, those cycles can certainly affect it. But I still think like, if you look at, for example, the FANG stocks, 5,
Hmm.
10 years ago when they were earlier on,
Yep.
they could brush off these, economic cycles pretty significantly, even when they were over $100 billion in market cap, because they were still pretty small in the grand scheme of things. And so when I look at later this year, for example, on one hand, I'm looking at the fact that most of the fiscal stimulus seems to be behind us. People are not getting these kind of quick capital injections that they could put right into the market. They could put
Right.
it into meme stocks, they could put it into cryptos, and those aren't really on the table anymore. On the other hand, we see some of the, it looks like rent inflation is pretty substantial right now. And, as we go forward, a lot of people are anticipating that, inflation is going to cool off. But I think the next leg to keep this inflation number overall kind of elevated is those rent increases. And so when you have,
Yeah.
super low treasury yields combined with inflation that is pretty sticky, that continues the narrative for these assets that have more scarce supply models, especially Bitcoin with its, absolute scarcity. And so I think that, when you contrast those 2 points, we've already gotten a lot of the if euphoria cooled off in the market, like in the crypto market, I should say. As we go forward, I think it has a pretty strong base to build from. But I do think this, the lack of say fiscal stimulus is certainly one of the headwinds against the industry.
Sure. So not as much of an impact, but could have some slowdown in terms of a long-term effect, whether we see that going. Do you find that the low bond market in terms of pricing right now has any effect whatsoever in the coming months, or do you feel like that's not even related to where we could see crypto going?
Well, I think it's part of it. I mean, basically, the strength of, overall bond markets, the appeal of holding cash and bonds is one of the big contrasting points with, say, especially Bitcoin, because that's the one that's
Yeah.
viewed as kind of the digital gold. It has other attributes as well, but that's, the one that, say, more corporations want to have on their balance sheet, things like that. And so overall, I think, when you're contrasting those two and you still see money supply, broad money supply growing at a 10% rate, when you see inflation numbers of 5%, while treasury yields are not much higher than 1%, and cash, yields are less than 1%, that continues the narrative for why people want to own some of these assets, at least as a part of their net worth. And so I think as long as that, situation exists, and I think that's going to be a structure that we're going to be in for the better part of this decade. We might have brief periods of going back into positive real yield territory, but I think we're going to spend a lot longer than people think
Mm,
generally in this negative real yield territory, and combined with Bitcoin's network effects and the overall technology in the space, I think we have a secular growth story. And sure, there could be these quarters where it does poorly, but I think it's important to keep an eye on the big picture.
yeah. So overall, not necessarily a huge impact from a bond side of things, even with, because right now we see a lot of international movement in terms of bond acquisition because of the market price, which is, to me, doesn't it? I think that's pushing, in essence, kind of the market for bonds down, which obviously will have an effect on how maybe this rolls out. So low bond prices never not necessarily say or mean that it's a bad sign for cryptocurrency or the market in general as it goes forward. So go ahead.
Yeah, the way I approach it, basically, whenever if we have an actual liquidity problem, like we had, for example, in March 2020, then
Right.
cryptos are almost certainly to go down along with everything else, and probably more so because they're less widely held, they're more volatile.
Right.
Um, but if we just have these more economic slowdowns or even stagflations, I think the cryptocurrency industry can hold up well there because it's still they still have that underlying growth, that underlying network effect allows them to keep pushing through. So I think if we separate kind of an actual liquidity thing from more of a malaise, I think they can
Hmm.
perform very differently in those environments.
Last question on the crypto side, at least before we get into stable coin discussion here. On the aspect of where Ethereum's hard fork, the London hard fork, has kind of, an EIP 1559 is kind of put into play. What are your thoughts on how Ethereum is going to, and could it potentially decouple from Bitcoin being so closely traced in terms of price position with this new kind of evolution and on its way to truly an ETH 2.0 position? What are your thoughts on that?
I think it'd be hard for them to decouple entirely, but I certainly think that this should be, in theory, tactically bullish on Ethereum with, say, a 6 to 12-month view, because what you have is the combination of ETH2 is not here yet, so
Yeah.
staking's happening, tokens are going into that smart contract and being locked in there, and so if you look at exchanges, for example, Ethereum's coming off of exchanges, going into
Right.
that lockup period. It's kind of like the grayscale effect. And then
Mm-hmm.
you have, this new EIP 1559 has reduced the issuance most likely. So far, we're seeing indications that they might even be disinflationary, or deflationary. They potentially burn Ethereum faster than they create it. And so that combination should be pretty constructive for the price. I think that you could even have another bubble form because of that dynamic. Now the tail risk there is that we have renewed SEC focus on the crypto space, especially focusing on which assets are securities, and if whether or not Ethereum's a security, the ecosystems, all the DeFi protocols, all those liquidity and trading areas probably do have a lot of things that the SEC would consider a security, and so
Mm-hmm.
I think that you could wake up one day and there's news that brought down Ethereum by 10% or more on some kind of more a step up in some of those enforcement actions. So I think assuming something like that does not occur, then it by itself, this hard fork should be pretty tactically bullish for Ethereum in particular.
Yeah. With legislative pressures coming in, I was a bit surprised over the talks that at least I've had a chance to view with many of our legislators kind of in position one in the sense of what their original proposal, and then some of the senators and congressmen that had basically initiated a rewrite, somewhat of a rewrite, at least in clarification. It seemed like some of the lawmakers actually had their head around what is happening here. I was somewhat pleasantly surprised. What are your thoughts in terms of how legislation could roll out? Do you think we'll see anything this year, or do you feel like this is maybe a 2022 or 21, 22 issue?
So I think, we can separate the SEC from the lawmaker side. And so the lawmaker
Hmm.
side's about these new laws coming into play. And I agree with you. It's very promising to see, bipartisan move, because, those senators were on different sides of the political aisle as well. You
Right.
saw both Democrat and Republican senators, that actually understand the technology a little bit more. They came in, they heard some of the concerns from the crypto industry, and they came in and said, this is poorly worded. I don't, the people that wrote this don't fully understand the technology. And so it is good that one of my cases for a while is that the bigger that Bitcoin and the space gets, the more that, well-connected people own them, the more
Hmm.
politicians own them, that they have their own lobbying arm so they can make sure that their voice is heard. And so that actually, further reduces risk in some ways. That network effect is kind of part of that growth. And so that's promising. Now, the SEC is a little bit different because that's about enforcing existing laws, and making sure that they understand the technology to
Sure.
enforce what's already written. And so those actions could come anytime, and we could see some later this year. We could see some next year. This SEC under Gensler seems pretty adamant to focus on that space, and so I do think we'll see some announcements, in the next 6 months or so about some of how they view the space. And I think, I mean, one hand, greater clarifications needed, because that can get more capital going into the space eventually when we actually
Right.
see what is considered a security and what's not. On the other hand, that could be problematic for a lot of things that are might be then considered securities but haven't really been treating themselves as such.
Yeah. I like the approach on this, because what we've seen so far, you're right, is that when you get some clarification in the markets, it does help, especially with the structured side of things. And at some point, we will see ETFs move into place, and that's where it's really going to get interesting, because that's going to really start to bring in a lot of investors, maybe on the retail and even moderate size investors into the market, versus what we're seeing right now in some of these trust products like Grayscale and others that are out there kind of moving in this direction. Just there's so much news and going that direction. I want to jump to the next topic, and that is digital currency in general. From a global level, China obviously, the digital yuan, and then we see movement happening in Europe through the EU with maybe the digital euro already starting to test, and actually using some of the backbone, I think, of XRP in one of the tests that we saw. What are your thoughts on how fast digital currency can come to market in actual, maybe replacing fiat? Where do you think that's going to happen?
So I think it partially depends on the incentive structure of that particular market. And so I think it's not surprising that we've seen China be one of the first, because the whole thing with digitizing currency is that on one hand it gives fiscal monetary policymakers more tools. On the other hand, it opens up surveillance options and ways to you can like automatically deduct from people's accounts or freeze their accounts more
Yeah.
easily than they can in the current fiat system. And so because China leads more authoritarian, they've been quick to do that. In addition, one of China's long-term goals is to have less vulnerability to dollar sanctions and
Hmm.
overall reliance on the SWIFT system. And so they want to be able to improve their payment channels to, for example, be able to buy commodities in their own currency and have less kind of an emphasis on the dollar. And so overall, their incentives to roll out this type of digital security and a digital currency, I mean, are pretty fast. Whereas the United States, for example, is on the other side of the spectrum, where I mean they're at the center of the current system, so they have less incentive to move forward very quickly on this. And then you
Hmm.
have Europe would be somewhere in the middle. And so it's not surprising that's the general order that we've seen this play out. And
Right.
so, if you look at a number of IMF papers and things like that, I mean, they've emphasized the idea of digitizing currency and phasing out cash because cash is actually one of the impediments for them to go into negative yields. Because
Right.
if yields get too low, people can pull out their money. They always have that kind of 0%, that zero yield option of cash. And
Yeah.
so if they can make that harder, they can actually then potentially go deeper to negative yields. So it's one of those things where you might have policymakers want something, but consumers it might not be good for consumers, and it'll be interesting to see how they sell that. And probably that comes with you see, for example, in China when they were doing their testing, it comes with kind of free currency, right? So they get
Right.
people into the system by offering it, and I think you probably see similar events in Europe and the United States as they test it and as they get people to accept it.
With okay, so with China, you've got the Belt and Road program that essentially is in play in, literally, I guess I think the last number I saw was like 150 something countries that were active with the Belt and Road Initiative with what China is trying to do from an infrastructure standpoint. Do you think that has any potential to roll out the digital yuan in a lot of these countries that are involved in these to potentially trade with China for those kinds of initiatives and potentially put China in a driver's seat in terms of a world reserve currency?
I think to some extent. And so if you look at the world map 20 years ago, a little after 2000, the United States was the world's like the largest trading partner with the majority of countries, and
Right.
China had a much smaller share. When you fast forward to 2020, where data is, the full year of data is available, China is by far the world's largest trading partner with most countries. The United States does North America, a little bit of Europe, but China's pretty much, taken over that map. And so that's relevant in terms of trading pairs. And so we see, for example, that Russia has been de-dollarizing and
Yep.
they've been selling their energy more in euros. Even with China, interestingly, they're actually using the euro quite a bit, but they are also using their own local currencies to some extent. And so Russia now has some exposure to Chinese assets. Also, China's in the SDR. We just saw the IMF is now working on issuing about 650 billion of new SDRs, and that roughly more than triples the total number of SDRs in the global reserve system, right? And so China's currency is part of that basket. And so overall, I do think that, especially with the CBDC and China's large network of trading partners, you could start to see more pools of reserves in Chinese assets held in some of these countries. However, I
Right.
don't view it as displacing the dollar. I view it as that the whole world's kind of shifting into a somewhat more diversified reserve basket where you have kind of
Hmm.
regional reserve currencies rather than like one major currency. And so you'll see it makes sense for Russia to have more euro-based exposure, North America and parts of Western Europe, more dollar and euro-based exposure. As you go into China and some of their big trading partners, you could have more yuan exposure in addition to probably still having dollar and euro exposure as well.
Yeah. Yeah, for sure. All right, so you mentioned Swift and kind of the economic infrastructure in terms of being able to move money around the globe. Explain to us a little bit about swap lines between central banks, how that works, what it's used for, kind of how its role that it played during the pandemic, to kind of put the case out there to some of our viewers.
Yeah, so the overall, taking a step back for a second, the world has a lot of dollar-denominated debt that's held outside the United States.
Hmm.
And so back during the pandemic, it was somewhere around 12 or 13 trillion dollars of USD debt. And the tricky thing is, of course, in the United States, they can print more dollars and bail those industries out pretty easily, as we've seen in some of these events.
Right.
Whereas in those markets, those governments don't have the ability to print dollars or necessarily even have a ton of dollars on hand to loan. And so when you have global trade dip because of a pandemic or because of recession in general, the dollar-based income of those dollar indebted entities can start to dry up. And then so they basically have that demand for dollars to service those debts. And so you can get a supply demand mismatch that spikes the dollar compared to other
Mm.
currencies. And then what happens is we also see that the world does have a large amount of treasuries in their reserves and things like that. And so in an emergency, they can sell their treasuries to get dollars. And so you can see, for example, in March of 2020, the U.S. Treasury market became rather illiquid because you had a very large amount of forward selling all at once. And so the Federal
Yeah.
Reserve had to come in and reliquify that market. And the one thing they did was, they basically did these measures like swap lines to say, okay, stop selling your treasuries. With certain countries, we can do these swap lines where we'll give you dollars in exchange for collateral, and then they pay that back when there's less of a squeeze. And so that basically is a way to stop that loop from continuing, right? Because if dollars get scarce, it becomes even harder to get them, and then it increases the demand even more. And so they want to put that flywheel back down. And so we saw that in 2008, for example, you saw the swap lines go out. Then they came back down as things settled, and then we saw swap lines go out again in 2020, and this time they included more countries on the list. Now, the interesting thing
Right.
is that most countries didn't really use them heavily. It was mostly a handful of countries, and that came down back down pretty quickly. But they still have those in place in case that should come up again. And it's also worth noting that that $13 trillion around the world often isn't owed to the United States. It's actually owed to China, owed to Europe, owed to Japan. So you have, for example, China. That's part of the Belt and Road Initiative. Is China runs these surpluses with the United States, trade surpluses. They
Right.
collect all these dollars, and they used to funnel those into treasuries. But now they say, okay, we're actually going to make dollar-based loans to these other countries, these frontier markets usually, or other emerging
Hmm.
markets. And then if those loans default, generally they're collateralized by infrastructure. So China will get a port, they'll get a railway, they'll get
Hmm.
hard assets if those loans default. And so we have this kind of weird, geopolitical kind of chessboard game going on, and that's part of why I think we're moving in a more diversified currency basket exposure because this current system is getting towards the end of its life as it currently looks, I think.
Yeah, and I think that's the point I'm getting at is that we do see monetary systems. I mean, essentially and inherently over and through history evolve about every 50 years or so. And obviously, we are at that edge case right now of where the U.S. dollar and also just the global currency requirements have really changed. Where do you see cryptocurrency and digital assets kind of rolling into that model? Because this is really kind of the first time where we've seen one, the market cap of crypto in general, digital assets, really see, in some cases, the likelihood is we're going to see a 2 trillion, maybe almost a 3 trillion if we see a real run up here. That's going to be a real impact in terms of a global ecosystem. Do you feel like this is one of those things where cryptocurrencies, digital assets is going to coexist with this other infrastructure that's essentially in place right now that people are, when I say people, countries are really vying for in terms of stability? Where do you see that playing out?
So I think for a long time, yeah, they're going to coexist. And so, if you start with, I think the first, the thing we'll see is these rollout of these CBDCs, right? So China's obviously ahead of the game there. We also have the
Yeah.
Bahamas with CBDCs, but I think that'll become more important over time. We could also see the implementation of some private stable coins used for payments rather than just trading, right? So things like Facebook. And so
Right.
I think that's one of the first major things to look at. Now, over time, if we continue to go in a more diversified foreign exchange basket, and you have energy being priced in maybe three different currencies rather than primarily in the dollar,
Hmm.
then that increases the usefulness of neutral bearer assets. And so we've seen, for example, that since 2008, central banks have been buying gold again. So Russia, for example, especially countries that are de-dollarizing like Russia, they've used gold as one of their replacements. to have that exposure. And so it is possible that if Bitcoin gets big enough, much larger market cap, multi-trillion dollars, if the volatility comes down, you could start to see some of the more adventurous central banks maybe have a Bitcoin allocation. Now, I'm not sure if
Right.
that's going to happen or not. I mean, I would not have predicted what we saw out of El Salvador happening here in 2021. I thought, maybe
Hmm.
years in the future to see something like that. So I wouldn't be surprised to see some central banks start to use some of these bear assets as neutral reserves. Once they,
Yeah.
the longer they go, the more de-risked they get, the larger the market cap, volatility can kind of, smooth off to some extent as they're held in a broader number of hands. And so I do think that those could eventually be part of the global financial system, but it still remains rather early to say for sure.
Yeah, and I think that's the point. Anybody that's watching our show knows that they're in early, very early in the digital asset and crypto space, likely mainly because, whether for whatever reason, in terms of their passion for getting into it, they understand kind of the evolution of where it's going. I like the fact that we are in a position now where if this market can stabilize, if it can get to, say a $2 to $3 trillion market cap value, there are some very interesting, chess moves I think that are going to be in play for maybe over the next few years, which really will accelerate some huge investment class movement. I want to get to stable coins here because you got a little bit of a struggle. I won't call it a struggle, but you've got USDC and Circle and kind of their innovation of what they're trying to do. Obviously, with Circle getting ready to go public through a SPAC. You've got Tether, of course, which has always been somewhat. I won't call them pressured, but they've been in a position where they're fending off a lot of pushback due to valuation to what the core infrastructure of what Tether is worth. Your thoughts on stablecoins? Do you think we'll see more of those start to develop as the market matures, or do you think we'll see more consolidation?
I think we'll see more and we'll see more diversification. And so
Okay.
back in the beginning of 2021, I said I was really, bullish on the amount of stable coins in the space. Since then, it tripled, which is actually faster than I would have guessed. And we have seen more diversification away from Tether into USDC. And I think probably USDC will probably one of the fastest growing ones.
Hmm.
But I think we would likely see a broader array. We're also seeing interest in other countries of launching stable coins that are backed by other currencies. And so you see Russia interested in like Sberbank, for example, is interested in ruble-based stable coins. You see, European countries interested in it, and so I think this is, likely to be a pretty global phenomenon going forward, and that this market still has a lot of room to grow, and probably among multiple players. And I think the bigger it gets, and the more it kind of moves out of just the crypto trading place, because early on, I mean,
Yep.
one of the points of stable coins was that it was really hard for, a lot of banks didn't want to work with crypto companies, they didn't want to work with
Hmm.
exchanges, and so, basically, if you could get a stable coin, you can go into these offshore exchanges, use it as a unit of account. And so, but as the industry's matured, they have more banking relationships. And as these products have gotten bigger, naturally, people want better collateral assurances. We want
Right.
to make sure that they own what they say they own, and then specifically that they're most. I mean, if they're calling themselves a dollar, they should be primarily invested in cash, T-bills, and other riskless dollar-denominated assets, right? So if you cobble together something that's equivalent with a dollar amount, but it's actually, has credit risk, and it might even own bonds that are not even denominated in dollars, that can raise some regulator red flags. So I think over
Yeah.
time we'll see that some of these bigger ones start get a little bit more solidified with their collateral, and then they can be used for payments. We already see, for example, Visa has partnered with I believe it was Circle for incorporating
Right.
stable coins into part of their ecosystem. And I think that kind of announcement will grow over time, and this will probably become a bigger space. And I think the remaining question, very long term, is how is that going to work with CBDCs? Are they going to
Yeah.
work with stable coins and kind of have stable coins be an extension of CBDCs, or you're going to see some markets try to phase out stable coins and then really emphasize their CBDC only.
Right. Because I think that's going to be a factor that at some point will have some direct implication, much like what you talked about there with the El Salvador, of the government essentially enabling Bitcoin as a unit of measure to be able to transfer money out to their people and et cetera. Much like what we, here in the US, when we went through the stimulus, it was, you're still the IRS mailing checks in most cases, maybe doing a direct deposit that was about the extent of it versus a digital wallet and what maybe a central bank digital currency could mean if that were to occur. And we see central banks really adopt these in a big way, potentially whether it's partnering and or coexisting with stable coins. At some point, there's going to be a digital wallet that starts to become, whether it's regionalized or global, in the essence of being able to reach population. Do you feel like that starts to create a lot of pressures, downward pressures on the existing banking system? Because now you've got all these new pressures coming in, and digital seems to be the new era here. What are your thoughts for the future
I
of
think so. I
banking?
mean, yeah, just like how we've seen fintech eat into the traditional banking world, I think that this ecosystem is kind of an extension of that, potentially much larger than that. And so if banks don't kind of keep up with that, don't maybe acquire some key technology in the space or don't
Right.
implement that in their own business, I don't think it's one of those things where banks are just going to crash. I mean, there's still important lending services that banks do, but I think that they can become a much smaller market share over time if tech companies end up being the big payment companies. And so if you
Yeah.
see, for example, Facebook stable coins or other companies come out with these stable coins, and they start to take up a much larger share of payments, that can eat into credit card payments or
Right.
overall banking services in general. But it
Yeah.
depends on the bank. I mean, one example I like to use is that Sberbank of Russia. Their mobile app has extremely high penetration. They owned some tech investments. And so, I mean, it really kind of comes down to if a bank is kind of forward looking enough and is starts kind of incorporating technologies and becomes kind of a technology company in their own right rather than purely sticking to the legacy system. And so we've seen years ago banks would generally dismiss Bitcoin in the broader space, and then
Hmm.
now of course they're embracing it more. And I think the ones that embrace it faster and smarter are likely to stay relevant for a lot longer than these other banks that maybe just don't get the memo and they become more niche lending institutions.
Yeah. Yeah. That's kind of our thought is that, we've talked about this a lot about where the banks could be displaced quickly, depending on their acceleration and just as you said. Last question, and that is, Lyn, if you look at the current market as it is, there's a lot of action in the space. If you're watching close enough, and again, I think a lot of people still that watch our show are maybe for the first time are realizing what crypto and digital assets are. But what we are seeing is an evolution in how currency and the monetary system is going to be utilized. Do you think we'll see the end of fiat maybe by 2030 to where we would be using digital, whether it's an e-wallet or phone-based transaction protocols because of the evolution of whether you look at Lightning or many of the other protocols out there to handle payments both in crypto, but then also with CBDC and digital wallets. Do you think we'll see fiat start to move away? Paper cash, paper money just disappear.
When you look out 10 years like that, it becomes more likely. And so,
Yeah.
we've seen obviously different countries is taking shape at different speeds, but we see even before, these technologies, just mobile payment technologies in general. We saw, for example, in China, that became by far the broad means of payment. Even among, there's like jokes that, if you go to China with currency, you have a hard time getting people to accept it, right? It's like
Yeah.
literally people that are asking for money on the street will have a QR code in some cases. And so basically,
Yeah.
there's this very broad usage of those mobile payment systems. It's interesting because they kind of leapfrogged over the credit card space and they went
Right.
straight to the mobile space. The same thing you see with India. And so I think that that's a model of probably where we're going. Of course, with instead of those mobile wallets would then have probably these digital currencies in them. So it's an evolution from that. And so I think it's going to become an increasingly important share. Now, whether or not it's completely phased out by 2030, I think that's hard to say. Um, again, it's kind of one of the big downsides of all this is that you basically reduce your privacy, reduce your ability to kind of opt out of
Right.
the monetary system, except for things like Bitcoin and other assets like that. But it is pretty challenging from that perspective. But I think in terms of where policymakers want to go, I think we're probably heading towards increasingly reliance on these mobile payment systems over these, physical cash, physical cards, and things like that. I think that direction is pretty clear, and we've already seen it in some of these other types of markets.
Why do you think the U.S., Lynn, has been so slow to make that transition? Because we do have companies that have been very effective with this. If you just look at Apple Pay, obviously Apple Pay has been a slow uptake in terms of some retail environments, but I use it, almost every day. And I found it to be just, it's very efficient, seamless, it's got all the tool sets I want. Why do you think it's the banks that have kind of held this back, or just the innovation with the banks themselves and or the companies to be able to provide this tech?
I think there's a lot of reasons, but I think ultimately it comes down to incentives in the sense that, when the payment system is good enough, that
Yeah,
network effect of just people's habits don't really change very
yeah,
rapidly. And so I'm not, I've never been looking out and saying, "Hey, my payment solutions are awful. I need better payment solutions." I'm always like, "Yeah, this is fine," and so I kind of keep
yeah,
using it. Whereas in countries that are, maybe emerging markets, and they don't have as big of that consumer credit arm, they, by the time they got up to that level, they were like, well, now smartphones are taking over the world, so we can just leapfrog that, and that becomes natural. There's no existing, say, credit card or other system like that you're moving away from, and it's all just natively mobile kind of from the beginning. And so a
yeah,
lot of it is just habit and momentum, and the fact that in many parts of the world there hasn't been a very strong reason to quickly change. You start to get incremental benefits for people that go mobile, but it's not like one of those things where it's like 10 times better. And so I think that over time, it just, as kind of just time heals all things. And so it's one of those things
yeah,
where if you're born into an environment where these technologies are more normal, it just becomes the de facto. Whereas a lot of people that are using the older systems, some of them will adopt, and some of them, just the way that the demographics move, eventually shifts toward these other types of systems. And so I think it's
yeah.
partially just how things are path dependent. We had our different histories.
Yeah, I think you've touched on this a couple times today on these incentive structures that have kind of moved, mass adoption. With that in mind, right now you've got incentive structures right now with companies like, say, a Voyager or a Celsius, who are taking Bitcoin, USDC, and paying out just, insane amounts of interest. Which, if you think about, if you're parking a savings account, and USDC comparison, I'll just use Voyager for example. I think they're up around 9% on a USDC payment. If I were to park this in a bank, if maybe I'm at a quarter to a half point. That seems like a huge incentive for many people that are even just remotely thinking about, I just want to put my savings account maybe in something like a USDC. Why have we not seen more adoption going in that direction with these kind of offers?
Well, one is a lot of these entities, I mean, they're not FDIC insured. And so it's not quite an apples to apples comparison where you have a
Right.
risk-free, 0.5% rate versus a risk-free 9%. It's no,
Hmm.
it's basically you're taking on some degree of credit risk by having that higher yield. Now, I do think that the overall, so far, that risk reward proposition has been better if you compare it to, say, junk bonds,
Yeah.
right? So I mean,
Yeah.
junk bond yields are pretty low, and just equity yields in general. And so I put that into a higher risk bucket, but it has been attractive in that higher risk bucket as well. I think another overhang is that we have unclear regulation. What is a
Regulation.
security?
Yeah.
And so we see, for example, we've seen some states step up enforcement or start to do kind of enforcement actions against some of these entities, and so I think that that still needs more clarification. So it's one of those things where earlier participants in this rather small market have been rewarded with these higher yields compared to how much risk they're taking on. But I think as the industry grows, becomes more regulated, we get more clarification on it. Probably those yields will come back down. We're already starting to see that in some cases where they've been
Yeah.
cutting their yields. You see that in DeFi, for example. You see a lot of those yield protocols go down during this cool off in the market. And so I think that's a natural evolution over time where these will converge more and we'll get more clarification about risks and things like that. But I think that the main takeaway now is that those are not quite apples and apples products because one of
Hmm.
them does have credit risk.
Slight risk. I think for me, I do a lot of that right now in moving, traditional fiat into these kind of just because it's, to me, in that's a little bit of a tolerable risk, at least for what the reward is, because you get back to incentives on how that's going, and for me, that 9% is just too tasty. You have to take a bite. Anyway, Lyn Alden, it's been great having you on the show today. Thank you so much for stopping in. We appreciate your time.
Thanks for having me. Happy to be here.
Yep. All right. So you guys are listening in over on the podcast right now. Thanks for tuning in over there. Make sure and follow us if you're on Spotify, you can follow us versus subscribe. So, of course, if you have a comment, just hit it in the comments there on the podcast side. Here on YouTube, we'd love to get your input on what you'd like to see here on TechPath and on the Paul Barron Network, because that's really kind of how we flow. We look at what our audience is looking for, what they want to dive into. We've had a lot of requests for more financial analysis, which is why we brought Lyn on. And of course, we love to get your feedback. So that's the number one way to do it, is drop it in the comments. You can also, of course, subscribe if you like what you see here. And best of all, reach out to us. Just hit me up on Twitter @Paul Barron. We'll catch you next time right here on TechPath.